Okay, we're now on our second page, and I should have told you this. I hope you have your Chapter 11 material for the video presentation. Make sure you have that with you to review all of this, or you won't be able to follow it. But on page 2, we have Bob publishing a monthly newspaper. And the subscriptions cost $12 per year. And he sells 1,000 prescriptions in October. So we have 1,000 subscriptions times $12 is $12,000. So on October 31st, we're going to go ahead and account for it. We got cash, because we remember he did this in October. We got cash for $12,000, but the subscriptions do not even start until the next month, November, right? So right now, these are unearned subscriptions. So we will credit that unearned subscriptions for $12,000. We now are going to go ahead and prepare an adjusting entry for December 31st. So let's look, excuse me, at how much he's actually earned of his subscriptions. He's earned November and he's earned December. So he's earned 2 months. Well, if we divide our $12,000 for the year by 12 months, we earn $1,000 each and every month. So if he's earned 2 months, November and December, we're going to debit unearned subscriptions, right? It's no longer a liability to us of $2,000 because we've actually earned this money. And we'll go ahead and credit subscription revenue for $2,000 because now we've actually earned this money. The next thing we have is March 31st. We're going to excuse me, need to prepare another adjusting entry. So on March 31st, again, how much have we earned? We've earned January, February, March, 3 months. 3 months times $1,000 is $3,000. So we'll go ahead and debit unearned subscriptions for $3,000, credit subscription revenue for the $3,000. And that will take care, or it should be, similar to homework problem number 3. Next thing we have is Bob granting employees some vacation time. And the employees get 1 day of vacation for each month they work. So 6 employees work the entire month of June at an average daily rate of $100 per employee. And we need to prepare the adjusting entry at June 30th. So if he had, he's got 6 employees, average daily wage is $100. So to accrue for this vacation expense, it's going to be $100 times 6, and they get 1 vacation day. So times 1 will equal 600. So on June 30th, we are going to go ahead and debit vacation benefit expense for $600, and we'll go ahead and credit vacation benefit payable, because we're not paying it yet, they've only earned it, for $600. So we're just accruing the liability, right? Excuse me. And then, and this is an example of homework problem 4, and the next part is also for homework problem 4. The company recognizes 5% of gross earnings as pension expense. Gross earnings in June are $12,000. So we need to prepare the adjusting entry. Well, $12,000 times 5% is $600. So on June 30th, we're going to go ahead and debit pension expense for $600, and we will credit pension liability for $600. These are, it's kind of fun in this chapter, isn't it? And like I said, they make a lot of sense, so they're fairly easy to follow. We have one more in the homework problem. The next one is for homework number 5. They give you a whole bunch of different accounts, and what they're asking you to determine is working capital and current ratio. I'm just going to erase some of this. But all you need to be concerned with are what are the current liabilities you're given, what are the current assets you're given. Everything else you just ignore. So for our case, we have current assets of $25,000 and current liabilities of $15,000. So our working capital is our current assets minus current liabilities. So that would be $25,000 minus $15,000 which is going to give us $10,000. Next thing we need to do is determine the current ratio. The current ratio is current assets divided by current liabilities. Our current assets are $25,000. Our current liabilities are $15,000. So that will give us a current ratio of 1.67. And you would do the same thing with homework number 5. Again, ignore everything else you're given. You're concentrating on current assets and current liabilities. Have a good week.